Well, good afternoon, everybody. I'm Paul Johnston. I'm Director of the Institute for Fiscal Studies. I'm really delighted to welcome you to the 2023 edition of our Green Budget, supported by Citi, who have done all of the macroeconomic analysis with us, and by the Nuffield Foundation, who have, I think, for the 11th year in a row, provide us with some funding for this. This is, I said earlier today, I think this is a vintage green budget. We have done my colleagues have done some phenomenal analysis of the fiscal situation and the really quite dramatic challenges that are facing us. Those challenges are not going to go away over the next year as we run up to the next general election. So you can expect to hear much more from us about that. Today, we're going to have two very short introductions. First from Mark Franks, who is the Director of Welfare at the Nuffield Foundation. As I said, we're very grateful to them for their funding. And from Andrew Pitt, who's Global Head of Research at Citi. We'll then move on to Ben Nabarro, who is the Chief UK Economist at Citi, who will talk to us about the economic situation, macroeconomic forecasts, inflation, and all those sorts of things. And then Isabel Stockton from the IFS will talk about the fiscal situation. Now, there's an awful lot in the Green Budget, a lot more than we're going to be able to get through today, even in the macro and fiscal areas. We've also published previously to this, as part of the Green Budget, work on corporation tax, inheritance tax, the NHS workforce plan, skills and education policy, and other aspects of fiscal policy. So please do go to our website to see the full glory of what we have done over the last few months in preparation for this Green Budget. And of course, this is all in anticipation of the autumn statement in about a month's time, and we expect a spring budget in March. So I will say no more other than to say that you should all have the link to the Slido app. We will have plenty of time for questions, at least 45 minutes, if my colleagues keep anything like to time. So if you put your questions into that Slido app, vote up ones that you like or want answered, because I will see those first, and once our four speakers have finished speaking, we will go straight into questions and discussion based on what is in that, what has been placed in that app. So let me pass over straight away to Mark to give a brief introduction from the Nuffield.
Thank you, Paul. As Paul mentioned, this is the 11th successive year for which the Nuffield Foundation has funded and supported the Green Budget. And that period has seen austerity and the aftermath of the global financial crash. We've seen Brexit, the COVID-19 pandemic. We've seen war in Europe, major geopolitical tensions across the world. And the UK itself has seen 6 governments in that period. And all of these developments affect the UK economy and make the government's role harder and more complex. And so it's really important in that context that the Green Book provides such meticulous, transparent assessment of the economic situation. And it also aligns really well with the Nuffield Foundation's interests in social well-being and ultimately the impact on people's lives, which is why we've supported it for as long as we have. Now, in 2023, the context is challenging. So we face slow growth, historically high levels of taxation, high levels of debt, and high costs of servicing that debt. And it's unlikely to get much easier because we know we've got the coming challenges of climate change and demography. Just to give an example, the UK population is ageing, and the number of people aged 85 and over is going to double in the next 20 years. And these sorts of developments have huge implications for the labour market, taxation, pensions, and the NHS. And just to highlight one striking finding from this year's Green Budget, based on analysis of the NHS workforce plan, that shows that demand for NHS services will rise by an extra £50 billion per annum in the next 15 years. And that's more than we've just saved by scrapping the HS2 extension to Manchester, and it's that amount every year, or more than we currently spend in total on defence, if you prefer that comparison. And that's just one example of how when you take these really big numbers, you can lose perspective. But actually, the Green Budget is really good at providing that perspective and shedding light on the challenges we face as a nation. Now, any government in response to these challenges will rightly emphasise growing the economy and addressing the UK's poor productivity performance. But beyond that, there are hard choices that need to be made about whether to raise tax, whether to cut spending, whether to allow the amount of debt to rise yet further. And these are ultimately political decisions, but there are two general principles I think can be applied to them, which the Green Budget encapsulates. The first of those principles is transparency. So governments should be open and honest about the challenges they face. And the Green Budget helps with that because it holds the government's own account up to scrutiny and provides independent analysis of that. The second principle is that if we're going to face tough tax and spending decisions, we should at least tax and spend as efficiently and effectively as possible and ensure we create the right incentives in doing so. And as Paul mentioned, there's a huge number of recommendations in the report which provide options for doing that, more than what can be covered today, but it is well worth looking at the full volume. And just like its predecessors, that will add to a huge amount of material that will be available from Green Budgets to inform difficult policy decisions in the months and years to come. So it's with my huge thanks to the IFS and City for such a timely and useful and authoritative report that I hand over to Andrew. Thank you.
Well, Mark, thank you very much. And also, can I say my personal thanks as well to the Nuffield Foundation for the financial support you give Paul and the team at the IFS, which allows them not only to produce the Green Budget, to carry on much more broadly there, what I think is essential work, looking at the UK economy and the UK public finances, and done in a way which I always marvel at in terms of its detail, its focus, and its objectivity. I'm head of research at City. I'm going to give you some very brief opening remarks because really hearing from Ben and then Isabel is the key thing about this session, and then getting your questions. At City, we're absolutely delighted to be partnering again with Paul and the team at the IFS on producing the Green Budget. If I reflect from a year ago, we were actually presenting the Green Budget in 2022 pretty much at the midpoint between the Kwasi-Kwarteng mini budget and the ultimate hurried resignation of Liz Truss. And when we were presenting a year ago, we were already getting heightened levels of panic in UK financial markets. It would be tempting to say things are a lot more stable now, and in many ways they are more stable. I think you have in Rishi Sunak and Jeremy Hunt, two individuals, both through their demeanour and what they're doing, have brought a lot of stability back to public life in the UK. We actually believe that the pressures now certainly some pressures are greater than they were a year ago in terms of some of the economic challenges and headwinds. And that's something we try to tease out in the work we produced at City. And what we've done this year, as in previous years, is support Paul and the team with two chapters of the Green Budget, one on the global economy and one in much more detail on the UK economy, because that's really the focus of the debate and the work with the IFS. On the global economy, obviously, things are challenging. We think there is a path to a soft landing, but that path is narrowing almost on a daily basis. And against a backdrop of very anemic growth, global growth, we forecast next year, excluding China, at less than 1%. And China itself has a lot of challenges. And obviously the world is grappling not just with the post-pandemic period and the war in the Ukraine, but potentially shocks that could come if there was any substantial escalation to things currently happening in the Middle East. So we're left globally with elevated levels of public debt at the time of rapid interest rate rises. And probably if we look out through the rest of this decade, and maybe the dreadful events in the Middle East are a little bit of a foretaste of this, probably the chances of more supply shocks than you would have ordinarily thought of as an economic forecaster that you have to be aware of as possible headwinds that come into the future. And as Mark mentioned, climate and demographics, certainly in the advanced economies, are also big challenges that we at City write a lot about, not so much in the Green Budget, but in our other research. Just specifically on the UK is unfortunately in probably quite a negative special place in terms of economic headwinds, because not only, like most of the Eurozone, have we suffered with the imported inflation from supply shocks after the energy crisis with the Ukraine war, but we already were on a heightened inflation trajectory because of largely the fiscal stimulus that was brought in during the COVID period into the economy, and our own very special issue of Brexit, which we at Citi still see as an economic problem that hopefully the country could have done without, and unfortunately we're going to be grasping and dealing with for many years still to come. So whoever is the Chancellor a year from now, and for Jeremy Hunt now, it's an incredibly difficult situation. Remarkably little flexibility we see in some of the choices, whether they're economic choices or even political choices, with an election on the horizon. When Ben talks, he'll probably give you a sense that at Citi, our forecasts are probably on the more downward path for inflation and interest rates than consensus. But be what the specific forecasts be, actually, the challenges that we see are very substantial going forward here in the UK. And one of the big conclusions in our chapter in this year's Green Budget is that actually fiscal policy itself has to be a much more important and strategic arm for dealing with not just the current issues, but future shocks and crises, including what are the methods of fiscal transmission, what are the institutions that can help oversee and drive them. So if anything, the work of the IFS will be even more important than it is at the moment in coming years. So with that introduction, I'd just like to thank my own colleagues. I'd like to thank Christian Schulz, who's compiled the global chapter this year, and particularly Ben, who you're now going to hear from, who's put phenomenal work into the UK chapter this year. It's been a delight again to work with Paul and the team at the IFS. And Ben, I'll hand over to you now to talk everyone through our outlook for the UK economy.
Thank you very much, Andrew, and good afternoon to everyone on YouTube and beyond. Now, in terms of the two chapters that Citi have provided to this year's Green Budget, as Andrew mentioned, there is both a global outlook chapter authored by Christian Schulz, and then also a UK economic outlook as well. Across both chapters, there are 5 main points that come out of the analysis. The first, as Andrew mentioned, is that the global path to a soft landing, we think, is narrowing. This reflects more persistent overheating in the United States, which we think is increasingly exporting tight financial conditions to the rest of the world. But it also reflects a weak momentum in China that we broadly expect to continue. For both Europe and the UK, we think this implies a relatively weak global environment over the coming year. We also think that the UK itself is approaching something of an economic inflection point. Tailwinds from fiscal support and better than expected terms of trade outcomes have underpinned unexpected resilience over recent months. But these tailwinds, we think, are now beginning to fade. And the headwind associated with particularly much tighter monetary policy is, we think, only now beginning to gather momentum. The implication, we think, is a shallow recession for the UK through the first half of 2024. While demand will therefore remain relatively weak, on the supply side of the economy, we think the news is becoming a little better in the sense that we are seeing the labour market conditions normalise more and more and reallocation progress. The implication in a context where demand is likely to remain subdued, we think, is that unemployment is likely to increase and plausibly surprise to the upside. And then the key question, particularly for monetary policy, remains whether we have already seen UK price and wage dynamics already become de-anchored. Here, we think there are tentative cause for optimism in the sense that actually we think some of those data, at least in recent months, have turned out to be a little bit better behaved. Finally, when it comes to domestic monetary policy, there we think the Bank of England probably faces its toughest year on record and very likely a tougher period than that has just gone. The key challenge, we think, is trying to navigate ensuring a secure return of inflation to target over the medium term, which all else equal would imply holding policy pretty tight for some time, but weighing that up against growing risks to the real economy, and particularly those associated with balance sheets and asset prices. And in that sense, while the lesson of the 1970s may have always been to hold policy tight until you have confirmed that disinflationary process is in tow, we think that in a highly financialized, indebted economy, that may only be half of the story. So with that, turning first to the global outlook, as with the UK picture, the good news in recent months has been that inflation has been coming down relatively quickly across both advanced and emerging economies. After a period of really quite difficult supply-driven inflation and indeed weak activity, three plausible paths are possible for the global economy. One, of course, is recession, as the adverse income effects accumulate and policy support is withdrawn. Stagflation is a meaningful risk. And another, in the scenario we all aim for, is a soft landing where activity holds up relatively well and inflation comes down as supply conditions improve. Now, whereas at the start of the year we felt as though the risks of a soft landing were growing globally, in recent months the outlook has turned somewhat more negative. The US in particular is turning out to be much more resilient to higher rates, and that has resulted in a repricing of US yields and with it global financial conditions, which the rest of the world is now experiencing. And in the East, Chinese data momentum post the full reopening has remained relatively poor, and we expect that to broadly persist over the remainder of this year. For the euro area, that is something of the worst of both worlds, and there we expect a recession through the end of this year and into 2024 as a result. And in general, across the global economy, we are now expecting ex-China world GDP growth of less than 1% in 2024, fulfilling at least one definition of a global recession. Now, in terms of the UK outlook, there again, unfortunately, we think the picture is beginning to darken. Even in light of recent upward GDP revisions, the economic recovery remains relatively lackluster, with GDP 5.2% off its 2012 to 2019 trajectory, compared to a 2.6% and 2% shortfall in the US and the euro area, respectively. That said, in recent months, economic momentum has surprised to the upside, and we think this is primarily attributable to the specific dynamics of the terms of trade shock the UK has suffered compared to the fiscal support that has come in to offset it. So looking at the left-hand side chart here, for example, this shows the adverse terms of trade shock in terms of an increase in cumulative costs since 2017. And as you can see, there was initially a very large increase in imported costs through the tail end of 2021, 2022, with the adverse cost peaking in the second quarter. Since then, to the degree we've had further bad news, that has been more than offset by additional fiscal support, meaning that actually the UK economy has had a net tailwind that particularly has supported activity through the first half of this year. Unfortunately now, many of these effects seem to have run their course. And as these tailwinds fade, we think the headwinds associated with what I should stress is a once-in-a-generation repricing of interest rates, we think that headwind is just getting going. Historical estimates with respect to the impact of changes in bank rate on the economy vary, but generally a rough rule of thumb would suggest a 1 percentage point increase in bank rate deducts around about 0.8 to 1.2 percentage points from GDP over the subsequent 18 to 24 months or so. The error bands are of course significant, but one striking feature of most UK studies on policy transmission is that it takes time. And we think that if anything, policy transmission is probably a little bit slower now than in recent history. The key point here is as the UK population has got slightly older, we have generally seen fewer people carrying significant interest-bearing liabilities, or certainly in terms of their net position, there's a less of a shortfall. But it does leave households and firms more sensitive to changes in asset prices. And on the right-hand side chart there, you can see the cumulative change in the net worth of the private non-financial sector since the start of the pandemic. As you can see in the US, the private sector is considerably wealthier. In the UK, it was wealthier, but has since deteriorated quite sharply. And we think from this relatively weak starting position, an older population, to the degree we do see, asset prices fall, will be materially more sensitive to that from a demand perspective. Now, turning then to the outlook for the household sector, well, this is very much a sort of microcosm of some of the terms of trade themes I was describing previously. In recent months, as we've seen wage growth accelerate and energy prices come down, the outlook for real household disposable income has improved quite materially. You can see that in the red line of the left-hand side chart here, which shows a meaningful acceleration in terms of annual growth rates for real household disposable income. But while we have now seen a meaningful improvement in terms of real wages, one of the challenges for the UK going forward, or for the UK household, is that is likely to be increasingly offset by increasing net debt interest costs, which we think will weigh quite materially on household disposable income, and also passive fiscal drag that also constitutes another material headwind. The implication is, even though real wages are now turning positive, for households, we don't think we've yet escaped what has been a pretty persistent squeeze on incomes, and in fact we expect that picture to deteriorate as we go through the first half of next year. For firms, I think unfortunately there is a sense that many are facing a similar squeeze. A lot has been made of greedflation cross-nationally, and certainly in certain sectors of the UK economy, there is evidence that some firms have been able to pass on meaningful cost increases to consumers. But in general, total corporate profitability, which you can see on the right-hand side chart here, is actually lagging its pre-pandemic level and indeed deteriorating further. And we think that going forward, generally with pricing power quite limited, we would expect that subdued picture to continue to weigh on investment. One of the concerns, particularly as we go into next year, is that underneath this relatively subdued aggregate picture, there is a huge amount of dispersion in terms of the profitability and starting position of firms. And with many winding down deposits really quite quickly over the last 3 quarters, which you can see on the left-hand side chart here, our concern is that as resilience continues to ebb and as the increase in the cost of capital feed through, we won't only see a sort of linear fetter on investment, but indeed more widespread insolvency. And we are certainly expecting the dissolution rate, so the rate at which firms are closing, to remain elevated over the coming 12 months rather than to fall back. Now, if that sort of the implication of that aggregate demand picture is relatively soft in terms of the outlook ahead, one area where I think we can be a little bit or more optimistic on the UK concerns the supply side of the economy. One of the notable features of the last few years for the UK has been a shift in the source of macroeconomic volatility from the demand side, so spending, to supply side, so shocks to genuine economic capacity. And this has been particularly true of the labour market, where the UK has suffered some material distortions and challenges as it reopened from the pandemic. Now, the good news here is, as we've progressed, and particularly as we've worked through a sort of hiring backlog post-furlough, we have seen matching conditions improve quite meaningfully, and recruitment difficulties as overall begin to ease. So the left-hand side chart here shows the relationship between the unemployment rate and the vacancy rate, what's called the UK beverage curve. And an outward shift here shows a deterioration in the effectiveness of the labour market overall in terms of matching workers and jobs. As you can see, initially post-COVID, there was a very significant outward shift. And what we've been seeing in recent months is that curve has been shifting back, thankfully, which implies something of an improvement. Alongside that supply improvement, with the demand picture now softening, we are now seeing a more meaningful inflection in terms of labour market slack and unemployment. The data there is of course subject to greater uncertainty, but looking at the right-hand side chart here, you can see the total of the survey data around labour market conditions, and I think there is more clear evidence now of a broader inflection here that we should expect to continue. So labour market conditions and hiring is starting to ease somewhat. Now, in terms of the inflation picture, that very much remains the key risk for the UK, given the high rates that we've both suffered over recent months and continue to see. And there is still a risk, we think, of a meaningful shift in the UK's inflation regime. Now, to begin with here, it's worth stressing the good news. Inflation has come down a long way from Q4 of last year. And to the degree we have seen inflation remain somewhat higher, it seems to have become a little bit more idiosyncratic. So the left-hand side chart here, for example, tries to separate out headline CPI inflation between energy, which of course is somewhat idiosyncratic itself, and then also what you might think of as changes in relative prices, so things becoming more expensive relative to one another, versus the aggregate price level, which really should be our focus here when thinking about the risk of a more persistent inflationary issue. Obviously, headline inflation has come down a long way, partly because of energy. But what we have also seen is this shift from general price increases to things becoming a little bit more idiosyncratic, consistent with things like indexation effects and so forth. So in that sense, there has been genuine good news as the headline inflation rate has come down. And I think looking forward, we should take some very tentative sort of causes for optimism in terms of the behaviour of the recent UK data. You know, wage growth is of course very high, and that can be a reflection of a more material inflationary concern. But the right-hand side chart here breaks down or compares realised UK wage growth in the red line versus what a 2000 to 2019 model would suggest with the bars. And what it sort of suggests to us is the labour market was incredibly tight last year by virtue as a result of furlough. There was also, or has been, a material feedback from very high spot inflation into realised wages. But in general, it still isn't easy to find clear evidence that wage growth is now running away from those conventional drivers. So in that sense, you know, the relationship between wage growth and labour market slack, the wage Phillips curve, still feels to us relatively well anchored. And as long as that's the case, as the economy continues to ease up somewhat, we would expect domestic drivers of inflation to also ease up as well. The other point worth making, and probably the particular risk for the next 12 months, is if we were to see a recovery in firm pricing power and firm margins, that could underpin a more persistent sort of inflationary process and add to the risk of a more structural shift in UK wage dynamics. But one important feature of these data, and you can see it on the left-hand side chart here, is that at least for now, as costs have started to come down, generally firms are also reducing prices accordingly. So they're matching their costs with their pricing intentions. That's really important, because as long as you're not seeing that kind of recovery in margins and the initial compressed picture that I described earlier, broadly that suggests that demand is pretty subdued and there isn't really the sort of economic makings of the kind of more persistent spiral, certainly that the UK saw through the early to mid 70s, and indeed would be the basis for a more persistent tight monetary policy. For now, at least, the current data weighs against that. But I think it also adds to the risk that if we were to see, for example, a more material fiscal loosening over the next 12 months, that of course would change this picture and increase the risks of much higher rates for a longer period. So just to sort of wrap up and to conclude with a few thoughts on monetary policy. For the Bank of England, recent decisions, and particularly the scale of hikes that we've seen over the last 12 months, has been driven primarily by a desire to secure insurance against the risk of more persistent inflation. That has led to rates being increased aggressively for obvious reasons. Increasingly, we think that with rates at these sorts of levels, the motivation behind that, which is effectively a much greater cost of doing too little rather than versus the cost of doing a bit too much, you know, we think that balance is beginning to shift. And it's primarily to do with the potential for pass-through into asset prices, which if they accelerate meaningfully, we think in an older population that has the potential to feed back more meaningfully into demand, into unemployment, and that can be a self-propagating process. So one of, I think, the really important takeaways for us, given where we are economically, is this balance of costs, of effectively a fear for policymakers. We do think that that is beginning to change, and all else equal, that's one of the reasons why the Bank of England plausibly chose to pause in September. And we think from here we'll probably hold rates steady at least into 2024. Now, the recent experience of the UK and really this transition from demand-driven economic shocks to supply-driven economic shocks, we think that poses a really important challenge for policy now. If you think about the way the UK has responded over the last 18 months to that shock, be it the sort of energy shock in Ukraine or those that went before, the way the UK has responded has been to tighten monetary policy quite aggressively, but loosen fiscal policy at the same time, effectively pushing the two core parts of macroeconomic policy into conflict with one another. And of course, we had a particularly extreme version of that in autumn of last year. We think that's a very, very poor, compositionally a very poor response to these kind of shocks, particularly when it comes to securing insurance against embedded inflation. Monetary policy is hampered by the long lags on transmission, so you can only really secure insurance 2 years late. And it's also hampered by the blunt nature of the tool, which particularly tends to weigh heavily on investment, on reconfiguration, and subsequently worsen the extent of scarring. So we think that in terms of managing these shocks going forward, and it is our view that we'll probably face a decade of more persistent supply shocks, we think it makes sense for monetary and fiscal policy to work more closely together to complement one another in terms of managing the risk of more embedded inflation and to try and secure insurance against that. Crucially, I don't think that implies that fiscal policy shouldn't offer targeted support, but it does mean that monetary policy can't get into this same kind of arm wrestle with monetary policy, because I think what that will show, and I think in terms of the aggregate picture for the UK that we now see, it has been that contradiction which really stands at least as one core element or one core factor behind why the UK outlook currently now appears quite so challenging. I will leave it there and pass to Isabel.
Thank you very much, Ben. Good afternoon, everyone. I'm going to tell you a little bit about what all of what we've just heard might mean for the outlook for the public finances, as well as some of the risks around that central outlook, and putting particular emphasis on the risks that arise from policy. So reasons to think why perhaps spending might come in a little higher or revenues might come in a little lower than a central forecast would ordinarily suggest. So a really important part of the backdrop to all of this presentation, and indeed the autumn statement coming up next month, is a trend towards a bigger state. And one way to illustrate that is to look at overall government spending over time. So we can see here a huge peak during the COVID crisis, and then a second peak at the moment associated with the cost of living crisis. After that, government spending sort of starts to fall gently, but if we compare the point where we end up under this forecast, and notably this is the OBR's March forecast, that the last one we had, if we compare that point to, for example, where we were in 2007 and 2008 at the eve of the financial crisis and after a decade of new Labour governments, then government spending is still expected to be very elevated compared to that level, or compared to the level we were at before the pandemic. So why is this happening? Well, part of the story is about debt interest, the cost of servicing the government's debt. And we can see that by looking at spending on everything else. So government spending, excluding spending on debt interest. But we can see that even once we put debt interest to one side, that comparison still holds true. So even spending on things we like, nobody likes to spend money on debt interest, but spending on things like social welfare, things like public services is still elevated compared to these comparators before these two big shocks that we've had. If we now compare that to revenues, then we can see that after a parliament that is said to be a record tax-raising parliament, revenues are said to rise to exceed non-debt interest spending, or in other words, the government is said to run a primary surplus. So that was the March forecast. How have things changed since then? Well, we've just heard from Ben that Citi expects a pretty poor growth performance over the forecast horizon, and that lower real growth could be expected to depress revenues. So they're forecasting a recession in next year, followed by a weak recovery. Of course, for the public finances, it's not just real growth in economic output that matters. The cash size of the economy, the nominal size, is also really important because taxes are generally levied on cash quantities. So there's a direct channel there. And there the picture is a little bit more optimistic in that the March forecast was predicated on really extremely low inflation starting at the beginning of next year. So really unusually low, whereas Citi's forecast has inflation at what you might call more normal level throughout that period, and that would help boost revenues. Of course, more inflation is not an unmitigated good for the public finances, so part of that boost to inflation will itself be offset by higher spending on things like working age benefits. Now, one really important and interesting moving part in this forecast is going to be debt interest. Citi forecast bank rate to fall to around 2% from the middle of next year onwards. That would be a lower path in the medium term than the OBR forecast back in March. This is not what's likely to happen when the OBR comes to produce their new forecast for the autumn statement, because what they typically do is use market expectations and of interest rates, and those are up since March and remain above 4%. So these types of decisions about what kind of view you take on interest rates really matter for the fiscal forecast. And we can see that if we compare sort of different vintages and different forecasts for debt interest spending in 2026-27. So this is debt interest spending sort of a few years away in the medium term, once the sort of immediate very high spike that we're going through last year and this year has already passed. If we cast our minds all the way back to the March 2022 forecast, this was Rishi Sunak's last as Chancellor, and this forecast was produced before the full economic impact of Russia's full-scale invasion of Ukraine became apparent. And under that forecast, debt interest spending was set to be 47 billion. Fast forward a year to the forecast from March this year, and that had been revised upward by more than 40 billion to get us to a forecast of 89 billion pounds. If we now take that forecast and adjust it for the most recent set of market expectations, then that could add round about another 20 billion pounds to debt interest spending in that year. If, however, we take Citi's view that by 26-27, bank rate will have come back down and gilt rates will have followed, then we might come up with an estimate of just 76 billion pounds of debt interest spending. And so I'd really like to draw your attention to that huge gap of 30 billion pounds. So that just illustrates that the kind of view you take on the future path for interest rates really matters for your fiscal forecast at the moment. And what does that mean for borrowing more widely speaking? So the Chancellor has a supplementary target, which is to have borrowing capped at a maximum of 3% of national income in the last year of the forecast. That was 2027-28 back in March. In the autumn, it's going to roll forward a year to 28-29. So under the March forecast, borrowing was set to fall from its current level to below 2%, so meeting that 3% target with some room to spare. And indeed, that's not very surprising because a 3% cap is quite a loose target, historically speaking. So outside of periods of huge upheaval and crisis, it's been extremely rare for the UK to be planning to run a deficit of more than 3% 5 years out. So it's not a particularly challenging target to meet. If we now, just as I showed you before, for debt interest, if we now update this borrowing forecast just for the most recent set of market interest rate expectations, then that would add noticeably to borrowing. Borrowing would then in the current last year of the forecast come in at slightly above 2%. If instead we adjust for the whole of Citi's baseline scenario, then there are some good news in the short term. So this year, borrowing is expected to come in around 20 billion lower than the OBR forecast back in March. This is consistent with the outturns we've seen in the first 5 months of the financial year and largely reflects a stronger growth performance of the cash size of the economy. But that improvement does not last all the way through the forecast horizon. And by the end of the forecast, under Citi's scenario, we might expect borrowing to come in at quite a similar level to what the OBR was forecasting in March. Now, whichever view you take on this, it's worth reminding ourselves that all of this would still mean that we would be borrowing substantially more than was forecast in March 2022, pre the cost of living crisis, just sort of for context. Now, with the government not borrowing very much at the end of the forecast and even running a primary surplus for the first time since the very early years of the new millennium, you might think that we should be in pretty good shape. But indeed, in a weak growth environment, that is only just enough to stabilize debt and is not enough to get debt on a decisively falling path. So this is the growth forecast, the debt forecast that the OBR presented back in March. If once again, we update that for the most recent set of interest rate expectations, then we would jump from a path where debt is falling by a tiny amount to a forecast where debt is rising, not steeply, but where the letter of the fiscal mandate, which says that debt should be falling by the final year of the forecast, would be missed. Under Citi's economic scenario, we would end up in a similar place, though debt would be slightly lower in the short term, and there too, debt would be just about rising. Of course, come the autumn, that fiscal target is going to roll forward a year, and where we are going to end up in the new final year of the forecast really depends on a number of moving parts. One of the most important one is the choice that the Chancellor makes for spending plans to be penciled in for that final forecast year. And it would probably not be too difficult to pencil in another set of very, very tight spending plans and get debt on a just about falling path. But we would really like to sort of take a step back, and rather than focusing on are we precisely and narrowly meeting that fiscal mandate to have debt falling by a hair in that particular year, because whichever of these paths you look at, none of them have debt falling decisively. None of them are creating significant fiscal space to respond to the next crisis whenever that might roll around. And again, it's useful to consider the contrast with the March 2022 forecast when debt was set to fall much more clearly. Now, all of these forecasts are predicated on government policy being implemented as stated. And there are a number of areas where there's at least some question marks around that. One of them is the freezing of thresholds in the personal direct tax system. And the freeze to pretty much every threshold you can name. So the point where you start paying income tax, the point where you start paying national insurance, where your employer starts paying national insurance, where you start paying the higher rate. All of those are frozen in cash terms, amounting to, under a current inflation forecast, a tax rise of £52 billion. And this would bring about 4.5 million additional people into the income tax system and lead to 6.5 more paying higher and additional rates of tax. So just to illustrate this, we can look at the share of adults that are paying income tax and the forecast under current policy of the personal allowance being frozen. That would reach a record level of about 2/3. On the other hand, had the freeze not been in place and the threshold been operated with CPI, as is usual, then the share of adults paying income tax might be expected to be around 10% lower by the end of the forecast period. The picture is even starker for higher and additional rate taxpayers, where the share paying those rates of tax is set to reach around 1 in 6 adults, whereas under the usual policy of uprating the threshold in line with inflation, it would be below 10%. So that's a really striking 80% increase. Now, we might expect that this is quite a stealthy tax rise, one that may not generate much political pressure. However, if it did, and if there were pressure on the Chancellor to end it early, for example, ending it 1 year early would reduce revenue by around £5 billion. Perhaps the clearest example where stated policy is not the most likely policy to be implemented is fuel duty, where the stated policy remains that the 5p cut is going to expire at the end of the financial year, and fuel duty rates will be uprated in line with inflation every year into the future. Now, it seems much, much more likely that what is actually going to happen is a continuation of the pattern we've seen in the past, that fuel duty rates will continue to be frozen. If that happened, that might amount to a tax cut of £6 billion by the end of the forecast period. The Chancellor has also voiced an aspiration to make the corporation tax full expensing policy, which is currently in place for 3 years, permanent. And he may find himself under pressure to top up spending plans, which, as they currently are, imply quite substantial cuts to unprotected areas, once existing commitments on areas such as the NHS, schools, and overseas development aid are taken into account. So, just to summarize, where do we find ourselves ahead of this autumn statement? Borrowing this year will be below the March forecast, and the tax burden is rising sharply and set to reach a record level. Now, that might seem like not a bad setting to implement some net tax cuts, and no doubt there will be calls for that. However, we think that the case for those is really weak, and this is not the right moment for them. One reason is that while borrowing is coming in lower than was forecast in March, it's still much higher than was forecast a year earlier. And this pattern that we've got ourselves into, where when things turn out worse, we absorb the additional borrowing, but when things turn out better, we spend the windfall, that over time leads to a ratcheting effect in borrowing and in debt, which is bad for transparency and potentially in the long run bad for fiscal sustainability. We're also still in a situation where inflation is high and interest rates are high and rising, not a great moment to implement a fiscal loosening. And just calling back to the beginning of the presentation, it looks like with both main parties' appetite to spend, the size of the state is set to remain above what we were used to before the pandemic or before the financial crisis. And with weak growth, even the current fairly tight policy setting is only just enough to stabilize debt rather than getting it on a decisively downward path. So if you just take one piece of advice for the Chancellor away from this talk, then it's certainly one thing to avoid, which is to implement immediate tax cuts, which would be implemented with certainty, and to quote unquote pay for them, or rather pretend to pay for them, with future tax rises or spending cuts that are penciled in for some late year of the forecast horizon and may never end up being implemented. And I will now hand back to Paul to chair the Q&A.
Thank you very much, Isabel. Thank you very much to Ben. And of course to Mark and to Andrew. We now have plenty of time for questions. We've got a few in the Slido, but a swiftly growing number, I'm pleased to say, because I know that there are many hundred of you out there watching. The one voted at the top is actually rather a good and interesting question, I think, and this I think is aimed at you, Ben. What would fiscal policy pulling its weight have looked like over the past 2 years? Raising taxes on households in the face of a cost of living crunch seems fanciful, although of course we have, the government has raised taxes on households really pretty substantially over the last couple of years. So, Ben, is this something that you feel fiscal policy should have done more of looking backwards, or are you really talking about future possible times?
No, I would probably say fiscal policy should have done more of that looking backwards, certainly earlier, even with the cost of living pressures as they are and as the questioner references. I think it's actually a very, very good point, because actually on the basis of current institutions, I would actually agree with what the questioner says. It's very implausible to imagine a chancellor of any political colour taking that kind of decision, given the kind of shocks that we faced. I guess the core point I would make, and this speaks to your observation about taxes, Paul, is that we're still suffering the same pain. We're just choosing to implement it, or rather distribute it in a different way via rates. So from a macroeconomic perspective, it's sort of the same story. We're just using different instruments, and in the process, as I argued, actually coming to a worse overall outcome by virtue of relying on rates with the lags as they are, and by virtue of not seriously engaging with how the UK absorbs that shock and distributes it across various stakeholders. That then poses an issue for UK credibility, which in a large dual deficit economy is a material issue. So in some respects, the way I would answer that question is to go actually to the historical experience of monetary policy. You know, if you look at the historical discussion of increasing rates into this kind of shock, you know, the Burns Fed thought that it couldn't deliver this kind of pain politically. It just wasn't able. So the answer to the question really lies in some kind of institutional reform that enables or provides fiscal policy with the space to play this role. And I would say that going forward, if fiscal policy is going to behave anywhere near the kind of idealized version that I described, you do need to engage quite seriously in those themes. So look, the questioner makes a very good point. I would say that from a macroeconomic perspective, fiscal policy should have tightened earlier. As I said, that doesn't mean that you don't provide targeted support, you just fund it in a different way. So I'm talking about the aggregate stance. But the other point that is worth keeping in mind is really where I'm arguing to is you have to think about institutional reform quite seriously over the next decade, because we know these kind of supply shocks are just going to keep coming. And by pretending that there isn't a cost to be allocated here seriously and not using the best possible tools, all we're going to do is make an already challenging decade even harder. So in that sense, I think the argument for some change here is pretty strong.
Really interesting, thank you, Ben. And yeah, it's terribly important to remember when talking about the balance between monetary and fiscal that, you know, the problem, as it were, with the monetary policy at the moment is it's creating a lot of pain for a somewhat random and particular group of people. And in a sense, I think one can reasonably argue it's up to government to decide how that pain should be distributed. Some more questions. There's one question here asking about our terminology using the term tax burden. Yes, that is just a shorthand for tax as a fraction of national income. Clearly, taxes pay for things and therefore are necessary as part of a welfare state. Equally, in an ideal world, we could get things for free, and so we'd all prefer less tax rather than more. But of course, we also want the things that taxes pay for. So you're quite right. It is tax as a fraction of national income, and tax burden is very much a shorthand, which is not intended to be derogatory, as it were, towards the use of tax. I think, as we've made clear many, many times, we don't really see any option at the moment to the level of taxes that we have, or at least to have an option would require some extraordinarily painful cuts in spending. So next question down, don't we need to reduce? We need to reduce debt to give us fiscal space for the next crisis. Sounds a bit narrow-minded. Wouldn't it be better to ask why these crises come round every 10 years, or indeed more frequently, and why we are so exposed to them? It's a very interesting question. I think I think there's a limited amount that we can do about COVID and energy price shocks. I think what the OBR would say is that the sorts of shocks that come round are unpredictable. I mean, we probably won't be a financial crisis or Brexit or an energy price crisis or a pandemic next time. We just don't know what it is, and therefore the best preparation we have for the whole possible panoply of shocks is to provide ourselves with some fiscal space. But Ben, I don't know whether you've got any sort of views as to whether there are other things that the UK state, the UK economy could do to insulate itself better from whatever fiscal shocks or whatever economic shocks may be coming around the corner.
I think it's an excellent question, because if I think about the last 30 years, certainly in terms of the UK's policy focus, ensuring a degree of macroeconomic resilience hasn't really been part of it. Now, of course, in recent times, there has been much more discussion around some specific industrial bottlenecks. So this onshoring policy agenda that has come to the centre of the policy discussion. But I do think in terms of how we might go about building a UK economy that is more agile, better suited to the kind of disrupted supply environment that I think most macroeconomic sort of forecasters, institutions think likely lies before us. And, the UK is always going to be a small open economy, so it's always going to face these shocks quite seriously. I do think there's more policy can do to sort of make the UK economy fit for that kind of reallocation. So certainly, for example, if you think about the nature of the energy shock, one of the reasons why I think there has been quite a strong skew towards providing, certainly pretty widespread subsidies, is because large parts of the UK economy simply can't suffer that kind of cost shock in a sudden way. There are ways we can structure or think about distributional outcomes, various different kinds of policies that can just underpin a little bit more resilience, and in the process make it easier in the event of a shock for the economy to adjust more quickly without forcing policymakers into really horrible trade-offs. So I think one of the key agendas for the next few years is to try and invest in that kind of underlying resilience, making the UK economy safe for a reconfiguring world. And I do think in terms of the policy agenda for the next 10 years, that goes way beyond investing in semiconductors. That's, I think, quite a fundamental change in the way we have to think about policy cost benefit. And this is, for macroeconomics, I think, quite a material change of pace.
Fascinating, thank you. Isabel, there's the question at the top is moving around all the time. Keep voting, because it's zipping around on my screen. But the one at the top now, Isabel, is what would a tax that moves with demographic changes look like? Do you have any sense of what that might mean?
Well, it's not a tax precisely, but I think it's in fact one of the success stories for, as it were, fiscal sustainability that the UK has had in the recent past is the mechanism by which we adjust the state pension age, where there's an automatic mechanism through which changes in life expectancy feed through to a stream of government expenditure that responds to that underlying demand. And that is probably one of the reasons why, while the UK faces a substantial challenge with population aging, it's not as big as that it is in a lot of other countries. So I think there's a case for thinking carefully about where are there other arenas of fiscal policy, of whether that's through tax or through spend, where we can introduce this kind of responsiveness so that tax and spend can respond in a way that's more nimble, in a way that's slightly removed from the kind of push and pull of everyday politics to respond to these long-term challenges like population aging.
Brilliant. I mean, I would add to that of course, at the moment, we don't tax, for example, occupational pension income or rental income. anywhere near as much as we tax earned income. And in particular, we don't have national insurance contributions paid on those incomes, despite the fact that if you've got occupational pension income, you will never have paid national insurance contributions on most of what goes in to that. And so whilst we have a tax system which favours the kinds of incomes that are drawn by older people, those who are not living off earned income, and also whilst we have a tax system which has not responded at all to the very big increases in wealth as a fraction of national income we've seen over the last 20 or 30 years, we're very much not in the position where we've got a tax system that responds to demographic change. And there are clearly politically difficult, but certainly economically feasible changes you could make to the tax system, which resulted in a smaller divergence between the sorts of tax revenues that come off the older demographic than the working age demographic. There's actually a rather similar question next, which asks, what do you judge the likelihood of the Chancellor making announcements that respond to the pressures of ageing, NHS, inequality, and so on, and what options are available to him? My starter on that would be the problem, of course, is that these are longer term issues, and particularly with a year, probably maybe less than a year to go to an election, they're not the sorts of things which you might expect to be top of mind for a Chancellor at any particular moment. It is worth saying, of course, that we have had long-term responses to some of these things. As Isabel exactly just said, the increasing state pension age has been one important part of that, and actually one reason why until now the fraction of adults over state pension age hasn't actually increased, because we've increased state pension age, and by the by, we also imported a lot of working age people through the immigration system. The NHS, we seem to be responding, we do a combination of ad hoc responses, which makes it very hard, by the way, for managers to manage the NHS, because they don't know until 3/4 of the way through the year what money they're going to get. They bet on it being topped up, which it nearly always is, but they don't know how it's going to be topped up. But alongside this extraordinarily ambitious and expensive NHS workforce plan, which was announced earlier in the year. But Ben or Isabel, do you have anything you'd like to add in terms of what are there things that we might think that the Chancellor could or indeed might do which respond to some of these long-term issues in the next fiscal event?
Well, there's plenty of options that the rest of my colleagues have worked on and that are in other chapters of the Green Budget. So I wouldn't want anyone to think that we're short of suggestions, including issues around NHS funding, issues around taxation of, as Paul mentioned, earned versus unearned income, corporation tax, and the list goes on. As to the likelihood of any of them being pulled out of a hat at the autumn statement, I am not sure we're in a good place to place any bets on that. Right.
What else have we got? We've got a question about the GDP deflator. I don't suppose other Ben Zaranko is with you there, is he, Isabel, or is he elsewhere online? Being GDP deflator being his number one issue? No. In that case, would either Ben, the Ben we do have, or Isabel like to try the GDP deflator? That's not something I'm going to try because it is really very complicated.
Right. So when other Ben does, as well as others who look at real terms changes in departmental budgets, calculate these real terms changes, then the measure of inflation is typically the GDP deflator, which is sometimes also called a measure of economy-wide inflation. And there are a number of reasons why that might not accurately capture the spending pressures on any given government department. And recently, a very salient one has been that increases in imported goods don't directly feed into the GDP deflator in the same way that they feed into consumer prices. It's worth saying that while this is a problem, it's not a problem that there's an obvious and easy solution to. So consumer price inflation, like the name suggests, is also not designed to perfectly capture the cost pressures on, say, the Department for Education, because schools also spend their money on different things than households. So there isn't sort of an easy, ready-made measure that would perfectly capture those pressures. So it's something to keep in mind when we think about the generosity of spending plans, but it's not really, and there's no easy fix, as it were.
Ben, did you want to add anything to that? I know that's something you've been thinking about, and indeed, one of the more difficult things we ask you to do is to predict the GDP deflator.
No, I think Isabel put it very well in terms of its relevance to fiscal uprating. I mean, all I would add is no measure of inflation is perfect. Certainly, when you look, for example, in recent times, even comparing sort of measures of the deflator implied by retail sales versus CPI food inflation, for example, those two measures have diverged a long way through over the last year or so, as we've seen households substitute, and in that sense, CPI will always slightly overestimate experienced inflation by virtue of the nature of the index, something like the GDP deflator, for some of the reasons Isabel argued, and then also by nature of its construction may underestimate in terms of the kind of loss of purchasing power that have been reflected in price increases. So, none of these measures are ever perfect. I would say that in a small open economy, going to the points Isabel was mentioning, it does feel strange in terms of the way the GDP deflator is sometimes used fiscally in sort of fiscal uprating to use something that excludes import costs, because certainly if you think about the experience of recent years and more general in terms of the UK's economic structure, that's a really important part of the broader economic story, and with it, the way fiscal allocation should be changing.
But it's a really, it really is, as you both say, a terribly important issue. One that usually gets skated over. Colleagues have tried to look at this, for example, in the context of spending on schools, where in terms of the actual pressures that schools face, it almost certainly understates it, not least because the cash increase in teacher pay proportionately is bigger than the GDP deflator, and it will vary by different areas of public service, and so some of them will find things tighter than others. But it's really worth digging under the bonnet to understand what real increases actually really mean in this context. Right, the sort of $6 million question, in a sense, next. I mean, given that we have got this challenging fiscal environment, and given that there is an election coming up, what goodies can we expect the Chancellor to throw in, if not in this autumn statement? And I suspect it probably won't be, but if then in the spring budget. But in either one of those, in the run up to election, it would be very surprising, as the questioner suggests, if there aren't any nice sort of sweeteners. And indeed, don't forget, it was only last March that he announced a £5 billion increase in spending on childcare for all children over the age of 9 months with working parents. And I think we can see that as a pretty substantial sweetener. But as you say, Isabel, we've been thinking about various of these things, including in the inheritance tax and corporate tax world. And any thoughts on sweeties or sweeteners, depending on how you want to put it, that the Chancellor might throw at us?
Right. So, I mean, I'm not sure I would describe what you, in fact, in the past described as a whole new leg of the welfare state as a sweetie, but be that as it may. I'm also not sure it would be consistent for us to tell the Chancellor that there's no room for net tax cuts and then end with a list of possible net tax cuts. Certainly, it seems likely that we're looking at another supposedly temporary freeze to fuel duties, and these are the sorts of cases that we highlighted in one of our chapters for the Green Budget, where you may argue what the better policy is on sort of on its own merits, but certainly we're in trouble in terms of transparency and in terms of the possibilities of effectively scrutinizing the government's plans if stated policy and actual likely policy don't align. And I suppose one of the mechanisms behind that, why that happens, is that it gives chancellors the opportunity to kind of hold something back and to pull a top up to spending plans out of a hat at the politically right moment. But it just means that forecasts are less reliable to start with. And so that's something we've been thinking about. What are things that could be put in place to discourage that sort of behavior a little more and improve the transparency of fiscal plans?
Absolutely, and a very obvious example of that is fuel duty, where it is in the plans and has been in the plans every year for the last 13 years that fuel duty will rise in line with prices, and it hasn't any year in the last 13 years done that. So in a sense, that will be no doubt unveiled as a sweetener in the spring budget. But there are obviously other things that the Chancellor could do. It could fiddle with inheritance tax, which is something that has been discussed, and indeed you could do that in a relatively revenue neutral way. You could reduce the headline rate of inheritance tax, for example, whilst closing some of the more egregious loopholes. For example, the total non-taxation of some forms of share ownership of agricultural land, of pension pots, and so on. So you could actually announce a reduction in the headline rate whilst, broadly speaking, maintaining the revenue. There are less attractive ways of providing sweeteners in terms of fiddling with rates of tax, whilst, as we've heard, really significantly increasing the coverage of in particular income tax over this period. But as Isabel said, I don't think we want to go in recommending or even providing bad ideas from the Chancellor at this point. Next question is an interesting one. Should the Chancellor be willing to miss his fiscal target if he's confident his policies, like the full expensing, making the full expensing policy permanent, if he thinks that will boost longer term growth? I'll come to you in a minute, Ben, on your sort of view of how the markets in particular see fiscal targets and meeting them. But I'd just say a couple of things about this. I mean, broadly speaking, the fiscal target to have debt falling in the fifth year of the forecast period is a really bad fiscal target. It is true that we should be looking to get debt stabilized on a downward trajectory over the longer term for all of the reasons that we've discussed. But what it happens to be doing on a very uncertain forecast in a particular moment in 5 years' time is not a great basis for that. And I think we would all agree that announcing the expensing policy as temporary because of the fiscal target, whilst broadly hinting that it wouldn't be temporary, is not a great way of making policy. The final thing I'd say is we have a full chapter on the expensing policy in the Green Budget, where my colleagues Stuart Adam and Helen Miller really argue that in the long run it will be a lot less expensive in any case, not only less expensive than it is in the short run, but actually quite a lot less expensive than the government appears to think it would be in the long run. Though whether that specifically is a great policy is slightly uncertain, not least because it provides pretty big subsidy to debt-fueled investment, which is not necessarily the way to go. But Ben, I'd be really interested in your view of how seriously the financial markets, the gilt markets, would see as it were, a technical breach of the fiscal rules. I mean, suppose in March, instead of saying that the rule to get debt going down in the fifth year of the forecast period, instead of being met by 6 billion, had been missed by 6 billion. Do you think that would cause any problems?
It's a very good question. I think a technical breach probably would have some effect in terms of its reception. I think particularly I sit day in, day out, just above a trading floor. So I see this, and it's very much firsthand for many of Citi's clients. But we are now living in a very, very different world as far as sovereign, the conditions on which the UK government can borrow compared to where we were just 24 months ago. It is a complete chalk and cheese. And I think in that respect, we do have to slightly revisit some of the discussion that was certainly taking place through 2019 and in the period post GFC, where certainly I would associate myself with a point of view to sort of say, look, we should err on the side of, really being quite generous in terms of sort of fiscal investment policy, trying to boost growth, etc. Because given where rates are quite so low, what that's telling you macroeconomically is there really is a free option to go and sort of, for want of a better way of putting it, sort of have a go. Now, that doesn't mean you waste public money, of course, but macroeconomically, the conditions were there for that kind of discussion to progress. Where we are today is a world where G10 sovereign debt markets, including the UK, have suffered some of their worst years cumulatively, not just since the 1970s, but arguably for many decades before. This has really been a hugely painful period for many investors. And there has been a change in regime where, particularly as central banks have stepped back, the ability of bond activists to sort of say, look, if you're doing something that we perceive to be potentially irresponsible fiscally, their ability to punish you is much, much greater. So I think in that sense, we have to be quite attentive in terms of any of this talk around, fiscal policy versus the fiscal rules. I think the market imposed constraint is much tighter than even those rules would suggest. And in that sense, rather than just thinking versus the sort of own criteria that the government has given itself, the other element I would reference with respect to that question of, say, doing a big further investment boost this year that may ultimately pay for itself, maybe it will, maybe it won't, is first to make the case, look, will investors be convinced? Because they have to be convinced if they're going to lend you the money to do it. And then second, are you going to, in terms of right here, right now, is now the right time to do it? And this speaks to this point about the interaction with inflation, taking the cyclical position of the UK economy seriously, and sort of in the process thinking about wider UK sort of economic and particularly inflation credibility in the face of these kind of discussions. So I would say we're in a very different world. I think a technical breach of the standards would have some effect, but actually the constraint is even tighter still. And I think we do have to slightly shift the way we're approaching the fiscal discussion in light of that changed reality.
That's really a really interesting answer as well. Thank you, Ben. It's of course it's incredibly difficult judgment on all of this, but I think that is a very striking piece of information, as it were, from close to those who are actually doing the buying and selling of this debt. I've been scrolling down these questions. There's one or two of them made me smile, I have to say. Should we just scrap the autumn statement and not bother? I think the answer is yes. We don't need 2 fiscal events a year. And should we put VAT on pet rabbits? That's a very good question, which I think refers to something that I have said on occasion about the complexity of the VAT regime, which means that we have to draw lines between what is and what isn't subject to VAT. And whilst most pets are subject to VAT, pet rabbits are not subject to VAT because they are edible. So if you want a pet, get a rabbit. You don't have to pay VAT on it. And of course, you can always eat it afterwards. There are a couple more questions about. Sorry, I'm not. By the way, I should say I'm not. I'm not suggesting that everyone go home and eat their children's pet rabbits. There's a couple of questions here on tax, which I'll take together. The question is slightly oddly phrased and say, what are the difficulties of the UK in becoming as good at taxing capital assets investments as we are at taxing labour income and the like? And I think there's part of the point here is that the big difference between how we tax returns to investments and so on compared with earned income is that we don't put national insurance contributions on that tax. So you pay income tax on your pension income, you pay income tax on your income from if you own a second property, on the rent from that. You pay income tax on investment income, but you don't pay national insurance contributions on that. And national insurance contributions are just a tax on earnings. And one of the consequences of this is that we pay a higher tax on earnings, earned income than we do on unearned income. There's all sorts of other changes we need to make to capital gains tax. For example, we should allow an indexation allowance there. It is absurd that we pay capital gains tax on nominal returns, particularly in a high inflation environment, but it's equally absurd that we entirely forgive from capital gains tax any capital gain which is made at death. So if you pass on assets which have made huge capital gains, then there is no capital gains tax on that. There are all sorts of other ways in which we could improve the taxation of capital, and I would point you towards numerous articles on our website, not least in the Merleys Review, which we published now a decade or so ago, but which still remains very much relevant to what we're doing. There's another question here about what the tax system could do to improve productivity, and I think partly the answer is the same. We really do need a tax system, and this applies to pet rabbits as well, which is more neutral between things that are more similar. So having a tax system which, for example, incentivizes you to be incorporated over being self-employed, over being employed, is damaging. The way that our tax system taxes housing in particular is extremely damaging, I think, to the economy and to productivity. And we can discuss a lot more. The structural corporation tax, the expensing tax policy is probably a move in the right direction, but we really do need a system which stops advantaging debt investment paid for by debt relative to investment paid for through equity. There are a whole list of tax changes which could be made, which would be good for productivity and economic growth, but which I'm afraid governments have shied away from for far too long. There's plenty more questions here. There's how high can debt interest payments go as a share of GDP before there are real problems? I suppose my sense is that there are already real problems, and actually pretty much everything that Isabel said indicated the scale of the problems that they create already for what we're able to spend. Ben, it looked like you wanted to come in from a sort of more of a macroeconomic point of view on this question.
It's just very brief. It depends on your ability to run primary surpluses, right? And how far you're willing to go down that route. So, I mean, I wouldn't, better to leave Isabel to talk about this, but it's, as Isabel presented, you see a primary surplus emerging towards the end of the forecast. That's the implication of interest rates being above nominal GDP growth. And I guess the difficulty for a country like the UK is how far do you think you can go down that route? Your sort of limit of your creditworthiness, so to speak, is how far you can run a primary surplus before it starts to look really politically too difficult, at which point you've got a world where plausibly debt can kind of run on a structurally out of kilter way. So I think it's really that primary surplus question that's key. And as you mentioned, Paul, I think given where rates are versus nominal GDP growth, we are already in a world where we're in a fiscal track where that fiscal tightening is going to weigh quite materially on demand alongside monetary policy. So from a macroeconomic perspective, this is already problematic. From an institutional perspective, it's that question of the primary surplus. And I do think it's striking. IFS have said it's the first time there'll be a primary surplus since the early 2000s. It feels like this is a pretty significant regime change that the increase in rates now poses.
Did you want to add anything to that, Isabel? I mean, it is in a way, I think this underlay an awful lot of your presentation, that we are facing up to the problems created by the very high level of debt interest payments.
For sure. Yeah, I think it's sort of worth distinguishing a few kind of different aspects of it. One is what Ben called this regime change of overall higher interest rates versus the risk of a high risk premium on UK debt specifically. So there are kind of we were worried in a different way about the increase in interest rates after the mini budget, then we are worried about that kind of permanent high level of debt interest spending towards the end of the forecast. The other thing is there are sort of, if we're asking about what specific number is a problem, then I think well, as with many of these things, it's a good idea to not get too fixated on like the particular number in a particular year. For example, this spike that we had last year and this year, not just because it's transitory, and transitory things are kind of inherently, it's a good idea to take a step back from them, but also because there are sort of specificities to how we account for debt interest spending that make that spike potentially look bigger, for example, in comparison to other countries, and there are elements of it where we score the debt interest immediately, but it doesn't sort of go out the door for a long time. So kind of the concentration in one or two particular years is a little bit artificial in some ways. So it wouldn't really do to get too hung up about how big is that spike. The thing to really worry about is debt interest settling at a much higher level. So if we look at the different vintages, I think that chart is in the green budget, the different vintages of OBR forecasts of debt interest at the end of the forecast period, that edging up, that is where we should really focus our concern in a way.
Great. We're running close to the end of time, but we've still got time for one or two more questions. There's again, taking the ones at the top, I got a very specific one here for you, Ben. I don't know whether you can say anything about it. Do you have a view on the impact of quantitative tightening?
Yes, so it's a really good question, bit technical. So there are two ways of accounting for this, one of which is a feature of the macroeconomic forecast. The other is not yet, but is something we're thinking about. So in terms of the impact of quantitative tightening, given it's already reflected in bond prices to a degree, or at least the announced component of it should be, we naturally factor in longer term yields into our forecasts, and that should, in that respect, capture the appropriate impact. Clearly, if there was to be a material change in terms of the trajectory of that announcement, that would have an effect. But the other point to keep in mind, I think, is this issue of equilibrium reserves in the system, which for now, this can all be quite nicely captured in a sort of linear, forward-looking way. But as and when we hit a point where actually reserves in the system are deficient compared to aggregate demand, which I think is fair to say is increased post the great financial crisis, then you can start to see more interesting interactions with financial conditions. So yeah, suppose it is accounted for in the forecast through that price component. One thing I would caution against is using a standard linear rule for this kind of effect. There was a sort of number kicking around that 50 billion unwind is worth another hike. It doesn't really work like that. It's much more state contingent and variable, unfortunately.
Just a little, why doesn't it work like that?
Because QE, in terms of, so when you have a QE intervention, there tends to be two elements to it. So there is a sort of longer term portfolio longer term channel in terms of a sort of portfolio rebalancing channel, so on and so forth, that tends to that you can think of as a more structural in a more structural linear way. But there is also an important liquidity component to a QE intervention. So in that sense, if you look at, say, the impact on the QE announcement in March 2020 versus, say, those in 2021, just to take the two most recent case studies, their combined impact on the yield level was very different, even accounting for expectations and so forth. And that reflects the sort of broader market conditions at the time the announcement is made. So it's really to do with the broader market context and the role that liquidity component plays in the announcement, as well as the more structural rebalancing channels as well.
And if I might just add, I'm not sure if that's what the questioner was after, but possibly. there is an impact from QT on meeting the fiscal mandate, in that once those losses start to crystallize, they start adding to underlying debt. So what we usually call debt excluding the Bank of England. So you kind of think of it in your mind as excluding shenanigans from QE and QT. It doesn't, unfortunately, work like that in this case. So there is a decent probability that a revision to those to be crystallized over the forecast horizon losses will make it harder to meet, again, the letter of that fiscal mandate. Although I would say that's not really what the fiscal mandate was targeting. That's not really what we're trying to hold the current chancellor to account for. So it's a little bit of a technical question that doesn't really come into the kind of scrutiny that a fiscal rule is meant to support.
Right. Well, we are. I'm sorry to the audience. We have ended on a rather technical note there. It's a technical question which Ben and Isabel have answered superbly, but very much getting down into the weeds there. But we are now at 2:30. I hope you all found that as stimulating as I did. I mean, I really do think there is an enormous amount in this year's Green Budget, both what you've heard from Ben and Isabel on the macroeconomics and the public finances, but I said also on the other areas that we've looked at, and we haven't even really said very much at all about the global economy, for example, which Ben's colleague Christian Schulz has written about, but as well as I said, also the various tax and other public finance issues that we and the IFS have talked about for listening and watching. Thank you again to the Nuffield Foundation for their support, and to Citi for working with us once again on this, and to Isabel and Ben for their fantastic presentations, and all of my colleagues here at the IFS who have worked on this. Thank you so much.